Hello everyone. In this video, we're going to talk about SBITAs, which are subscription-based IT arrangements, and PPPs, which are public-private and public-public partnerships. We will start by discussing the basic SBITA concepts and then walk through an example of how to apply the SBITA accounting and reporting rules. We will then define public-public and public-private partnerships and service concession arrangements, also called SCAs. We will then talk about how to report those types of arrangements. First off, we'll start with SBITAs. And essentially, we are just applying lease accounting to our software contracts now. The new SBITA accounting and reporting is effective for fiscal year 23. Many of our cash basis governments have a fiscal year end of 12/31. So for those governments, SBITA accounting is applicable starting on January 1st of 2023. Now, similar to when you implemented lease accounting, we really encourage you to review your software contracts and get started on this new accounting and reporting now, rather than waiting until the end of the year. Now, what is a SBITA? Here is our definition. It is a contract that conveys control of the right to use another party's IT software, alone or in combination with tangible capital assets, as specified in the contract for a period of time in an exchange or exchange-like transaction. This should sound really familiar because it's similar to that definition of a lease that we've talked about. The difference here is that this is specific for IT software. Basically, if you're paying someone else to use their software, you probably have a SBITA. One important aspect of the SBITA contract is the subscription term. And the subscription term is basically how long is the software contract. Here are the specific rules for calculating the SBITA term. First, the subscription term will always include the period that you have a non-cancelable right to use the software. Then you'll add on any extension options if you're reasonably certain that option will be exercised. For example, let's say your initial contract is for 3 years, and you have the option to extend for another 3 years. If you're reasonably certain you will exercise that option, the subscription term is 6 years. Then, if there's the option to terminate, but you're reasonably certain that option will not be exercised, then you would include that additional time in your subscription term. So let's say that the initial contract is for 5 years, but you have the option to terminate after the 3rd year. If you're reasonably certain you will not exercise that termination option, then your subscription term is the full 5 years. This does involve some professional judgment because being reasonably certain is not the same as absolute certainty. You'll have to consider the facts and circumstances at your own government. For example, is the software really critical to your operations? If so, maybe you'll exercise that extension option. Or are you actively searching for a new software to replace the current one? If so, you might not exercise any extension options. Well, this analysis is unique to each government because each of you has unique circumstances. Finally, any periods where both the government and the SBITA vendor can cancel the contract are excluded from our SBITA term. If both the government and the SBITA vendor have to agree to extend the contract, that is also excluded from the subscription term. So here are a few things to look at when you're trying to identify all of your SBITA contracts. But look at all of your cloud-based arrangements. That includes things like software as a service, platform as a service, and infrastructure as a service. I highly recommend involving your IT department in the process for identifying your SBITA contracts. You should also look at any cloud-based ERPs, other online items like conferencing, email, and payment tools. Here are a few more ideas to consider looking at. Any capital asset software, budgeting software, 911 or emergency dispatch systems, meter reading software, remote learning platforms, data or backup storage. Also contracts for things like DocuSign, Laserfish, OpenGov, Zoom, Microsoft Office 365. Really, any software that you pay for should be added to your list of contracts to evaluate. So now let's talk about exclusions, things that are not SBITAs. And the first one here is the short-term SBITA. And thankfully, the definition of a short-term SBITA is the exact same as a short-term lease. As a reminder, it's short-term if the maximum possible term is 12 months or less. And that maximum possible term includes all options to extend the contract, regardless of whether you think those options will be exercised or not. What that means is if your government has a contract for something like Zoom or Teams, but the contract is just year to year or month to month agreement, and you and that SBITA vendor can cancel at any time, that would be a short-term SBITA and not subject to this new accounting and reporting. However, if the contract is for longer than 1 year, it would be considered a SBITA. You'll need to look at your individual contracts and determine whether your government signed a year-to-year contract or whether they committed to a longer term. Sometimes governments do choose to commit to those longer terms because you get a deal. Sometimes the SBITA vendor will charge you less per year if you commit to using their product for a few years at a time. It really depends on what your government signed. The next exclusion is if you have a situation where your contract is for a tangible asset that has a software component, and that software is insignificant to the overall asset. An example of that would be leasing a smart copier, where the tangible capital asset is the copier, and it has that IT software component. But in this case, that IT component is very minor. So here, you're going to report the entire contract as a lease. You do not have to try to separate out the software portion to report it as a separate SBITA. The next exclusion is if your contract is for IT support services only and not the right to use that underlying IT software. An example of this would be paying for training for employees, or if you're paying for troubleshooting or help desk services. If you have a perpetual software license, which we'll talk about next, and then you pay a separate monthly or annual fee for technical support, that tech support is not a SBITA. So perpetual licensing agreements are also not SBITAs. Remember, the definition of a SBITA says that it must be for a period of time. However, a perpetual license gives you access to the software indefinitely, so there is no period of time. So let's look a little closer at these perpetual licenses. Now, perpetual licenses are the older model for software companies. Many companies are moving away from this in favor of those subscription-based models. A perpetual license is one where you download the software directly onto your computer or servers, and then you have access to that software forever or perpetually, which is why it's called a perpetual license. One easy way to determine whether you have a perpetual license or a SBITA is to ask yourself, can I still log in and access the IT software after the agreement term ends? If the answer is yes, you can keep logging in forever and ever, that would be a perpetual license. But if the answer is no, then you probably have a SBITA. Let's look at an example. One example that most people would be familiar with are the Microsoft Office products. If we think about the older versions of Microsoft Office, such as Microsoft Office 2000, those were perpetual licenses. You paid a one-time fee, You downloaded it directly onto your computer, and you were still able to use the software after it expired. Now compare that with the newer model of Microsoft Office 365. For Office 365, you have to pay that annual or monthly renewal fee. If you do not pay that fee, you stop receiving access to the software and you cannot use it after the expiration. This one would be a subscription-based IT arrangement. So let's test our knowledge. In this example, a government signs a contract for an online conferencing tool like Zoom. The initial contract is for 1 year. They make payments each year, and the contract automatically renews each year. The government intends to renew the contract indefinitely. Is this a perpetual license? No, this is still a subscription. So remember to ask yourself, can I still log in and access the IT software after the agreement term ends? And the answer to that in this case would be no. If you don't pay Zoom their annual fee, they're going to cut off your access to the software. That means you do not have a perpetual license. Now for the same scenario with that Zoom contract, our contract is 1 year and it renews indefinitely. What is our SBITA term? How do you calculate that? The answer here is probably easier than you might think. Our term is only 1 year. Typically, at each renewal date, both parties, the SBITA vendor and the government, have the option to cancel the contract. If you remember from a little earlier in this training, we said that periods where both parties can cancel the contract are not included in our subscription term. Those periods are also excluded from the maximum possible term. So that means the maximum possible term on this contract would be 1 year, so it's short term. Again, I want to remind everyone to look at your individual contracts. If both parties do not have the option to cancel at each renewal date, that would be a different scenario. Also, if your government signed a contract for longer than 1 year, that would not be short term. You really have to look at the contracts that your government signed to determine this. Now let's talk about the accounting and reporting. This is really similar to the lease accounting rules, so it's probably familiar to a lot of you. For our regular SBITAs, meaning they're not short term, you're going to record a subscription liability on the schedule of liabilities. This will be measured at the total amount of future payments. That's the same way your lease liabilities are measured. When you make payments on these SBITA contracts, you'll use BARS code 591 with object code 70, which is also the same way you code your lease payments. Now the two X's in that BARS code on the screen are placeholders, and those will correspond to what function of government the SBITA contract is supporting. So for example, if this SBITA was for water meter reading software, the government would use BARS code 591-3470. The 34 in that code represents the water function. You'll need to review your chart of accounts to pick the code that's most applicable to your situation. You can also submit a help desk if you need help selecting the correct code. Now, the SBITA will also be disclosed in your notes to the financial statements. If you have a short-term SBITA, meaning the maximum possible term is 12 months or less, you do not record that on your schedule of liabilities. You also do not use the 591 debt codes. So in our water meter reading software example, if that was a short-term SBITA, they would use BARS code 534 with object code 40. Let's walk through an example of how to report SBITAs on the schedule of liabilities. We'll also take a look at an example note disclosure for the financial statements. So here's our scenario. The government's fiscal year end is 12/31. They signed a 5-year contract for accounting software. It started on January of 2022 and it goes through December of 26. They paid $10,000 per year plus $820 in sales tax. They also paid $2,000 a year for technical support. Now, what do we include in our SBITA liability? We definitely include the $10,000 contract price for the software. What about the sales tax? Do we include that? No. The sales tax is excluded from our liability. Taxes are considered a separate component, and those are reported separately. Now, what about the $2,000 for technical support? That also gets excluded. It's not part of our liability. That technical support is a service. Your SBITA liability should only include amounts paid for the right to use the software. Both taxes and technical support are not payments for the right to use the software, so they are excluded. Here's what the schedule of liabilities would look like. So remember, SBITA accounting and reporting is applicable starting on January 1st of 2023. In this example, the contract started back in 2022. That means it existed before the SBITA accounting started. And that means we have to report a beginning balance on the Schedule 09. Now, the beginning balance is the amount due on the contract as of January 1st, 2023. And on January 1st, 2023, the city had 4 payments left to make. The payment for 23, 24, 25, and 26. And each of those payments is $10,000, so the beginning balance is $40,000. The additions for the contract are 0, and the reductions are the one payment of $10,000 that was made in 2023. And this would be coded to BARS code 591 using object code 70. Now our ending balance is $30,000, which is just our beginning balance of $40,000 minus the reductions of $10,000. Notice that we did not include sales tax or the technical support fee in any of those amounts. The payment for the sales tax and technical support would be coded to the normal functional BARS codes, which basically just means do not use the 591 debt codes. In this case, the city would probably use BARS code 51420, which is the financial services BARS code. You'll want to review your chart of accounts to select the right code for you, or you can submit a help desk and we'll help you with that. So here's an example of what the notes to the financial statements might look like. In the year of implementation, so in 2023, you should have this first paragraph that says you adopted the new accounting guidance for SBITAs. And this paragraph will only show up in 2023. In your 2024 and future financial statement notes, that paragraph would be removed. Next, you should include a quick description of the contract. This doesn't have to be extremely detailed, just a general overview to give the reader an idea of the major points of the contract. So in this example, we say the city makes subscription payments of $10,000 per year for its accounting software. The SBITA contract started on January 1st of 2022, and it ends on December 31st of 2026. The amount paid in 2023 was $10,000. And the final item that you have to include is a table of future subscription payments. So in this case, we still have a payment to make in 2024 and 2025 and 2026. So that's what's included in our future subscription payment table. Now, the total amount of future subscription payments that we report here in the notes to the financial statements should match the SBITA liability that's reported on the schedule of liabilities. If you remember our schedule of liabilities, the ending balance for this SBITA liability was $30,000. So the two amounts match. With software, it's fairly common for governments to prepay for a couple years in advance, so I wanted to show you how to report that as well. Now, in this example, we have a 3-year contract for budgeting software, and the government pays $30,000 upfront to cover all 3 years of the contract. To account for this, you would record a normal functional expenditure code when you make that payment. So do not use the 591 debt service codes for the prepaid SBITAs. There's also nothing to report on your schedule of liabilities. In this case, you made the entire payment up front, so you don't owe the SBITA vendor additional payments. And since you don't owe the SBITA vendor any additional money, there's no liability to report. Now we're going to shift gears a little bit and talk about public-private and public-public partnerships, also known as PPPs. So a PPP is an arrangement in which a government, who we call the transferor, contracts with an operator to provide public services by conveying control of the right to operate or use a non-financial asset, such as infrastructure or other capital asset, for a period of time in an exchange or exchange-like transaction. That probably sounds a little bit familiar because of how similar it is to the lease definition. This time, in addition to that tangible asset being leased, there's also a public service that's being provided by the operator. So hopefully this visual makes it a little easier to understand. On one side, we have the government transferor. In order for this to be a PPP, the transferor must be a government. On the other side of the transaction, we have the operator. Now, the operator can be another government, in which case this would be a public-public partnership, or the operator can be a non-governmental entity, in which case it would be a public-private partnership. Now, in the PPP, the transferor is giving the operator the right to use a public asset, and the operator is agreeing to provide a public service. Now, the transferor pays the operator to provide that public service, and the operator pays the transferor for the right to use that public asset. You can think of the transferor like a lessor. They own the public asset and they're letting the operator use it for a fee. You can think of the operator like a lessee. They're paying to use that government's public asset. The main difference between this and a lease is that the operator also now has to provide a public service. Now, in addition to PPP, we have what we call a service concession arrangement, also called an SCA. This is a special type of PPP, and it has to meet all of the following criteria. The transferor is going to receive significant consideration. Now, this can be a large cash payment from the operator, or the operator can construct a new asset that the transferor will ultimately own. Or if the transferor has an asset that needs significant construction or upgrades, the operator can fix up the transferor's asset. Also in an SCA, the operator is going to be paid by third parties. So they're going to be paid by the people that they provide services to, rather than being paid by the transferor. The transferor also gets significant control over the public services, and it gets to decide what services are provided, who they're provided to, and the prices or rates that can be charged to those users. Now, the transferor would also be entitled to significant residual interest in the underlying PPP asset. So that just means that the asset belongs to the transferor at the end of the arrangement and it has some useful life left in it. So here's a visual of the SCA. You'll notice a couple things are the same as the PPP. Our transferor is still giving the right to operate a public asset to the operator, and the operator is still agreeing to provide the public service. What's different here is that the operator is giving that significant consideration to the transferor. Also, the operator is being paid by those third-party users to provide that public service. One example of an SCA could be a toll bridge. So let's say the government has a toll bridge that needs significant updates and repairs. So the operator agrees to perform those repairs and the transferor continues to own the toll bridge. So paying for those big repairs would be the significant consideration. The transferor is giving the operator the right to use that toll bridge, which is the public asset. And the operator is agreeing to run the toll bridge, which is providing that public service. And the operator is going to be compensated by the people using that toll bridge, rather than the transferor paying them to provide that service. Now, in this case, the transferor would also be able to set the prices that the operator charges for the tolls and determine who the operator is required to provide the service to. So now that you know what PPPs and SCAs are, what do you do with them? Well, if you're the transferor, you just report revenue as it's received. You do not have a liability to report, so nothing goes on the Schedule 09 or the Schedule of Liabilities if you're the transferor. If you're the operator, then you will record a PPP or SCA liability on the Schedule of Liabilities. Just like for leases and for SBITAs, it's measured at the total amount of future payments. Also, like leases and SBITAs, you'll use BARS code 591 with object code 70 to report those PPP and SCA payments. You'll also have a note disclosure for the notes to the financial statements. Now, currently, we're not aware of a lot of local governments that have PPPs or SCAs. So if you think you have this type of arrangement, I really encourage you to submit a help desk so that we can look at your specific situation and provide more specific and detailed guidance. Well, thank you for watching this video, and remember to submit a help desk if you have any additional questions. Thank you.